Hello and welcome back, Advanced VITA volunteers. So in this lesson, we're kind of extending on some of what we learned in the basic training about cancellation of debt, and before we were talking about cancellation of credit card debt and how that needed to be added back into income. So now we're going to be talking about cancellation of debt, but on a principal residence. And there is a temporary provision that has been extended through 2025, where it may be possible for certain taxpayers to be able to exclude from income this type of cancellation of debt. So ordinarily a cancellation of debt would trigger reportable income and taxable income, but again, we have this temporary provision that is allowing some of our taxpayers to exclude that income from their returns and from their taxable income. For this topic, we really kind of need to introduce some terminology here. So again, this is a cancellation of debt on a principal residence. So we need to figure out, well, what is a principal residence? And a principal residence, it's generally a home where the taxpayer lives most of the time. And it's important to note that a taxpayer can only have one principal residence at a time. So qualified principal residence indebtedness is any debt that the taxpayer incurred to either acquire or construct or do a substantial improvement on their principal residence, and the debt would be secured by that principal residence. So, you know, this is going to be largely a mortgage, right? And then an extension of that is that it's any debt that's secured by the principal residence resulting from the refinancing of a debt incurred to acquire, construct, or substantially improve a principal residence. So if it's the first loan on that home, or if they have since refinanced, you know, maybe they were going to get a better rate, or some other reason they were refinancing. However, in order for it to be qualified principal residence indebtedness, the debt cannot exceed the amount of the refinanced indebtedness. So if it's a cash out sort of a refinance, or they're, you know, refinancing for a larger amount than what was originally owed on the home in order to, you know, pay off credit cards or student loans, that's not going to count for this. And we need to talk about two types of debt. So there is a recourse type of debt and a non-recourse type of debt. So the recourse type of debt holds the borrower personally liable. And that means that regardless of whether or not the property that is securing the debt is returned, the whole amount of that debt will need to be repaid. So, you know, if a home is sold at short sale and it comes up short of the amount owed, if the taxpayer would be, you know, required to make up the difference, that is a recourse type of loan. So lenders, they can collect what is owed beyond that collateral, the home. And the lenders would even have a right to garnish wages or levy accounts. Non-recourse debt, on the other hand, the borrower is not personally liable for the whole amount of the loan, right? So the collateral, the home, is once that has been collected, then that loan is considered done. It's discharged. So the lender is restricted to the pursuit of only that collateral. So, if this lender forecloses on a home, they have no rights to further legal action. Once they have the home, it's done. And we're going to talk about 3 types of canceled debt situations. However, the foreclosure and abandonment, we're going to bundle those together because they get similar treatment in tax. And then there's a mortgage modification. So with a foreclosure, the lender is taking the property back from the owner. An abandonment, on the other hand, is where the property owner gives up the right to the collateral, the home. And then a mortgage modification or a work around. The principal balance of the debt will be reduced, but the borrower is able to keep ownership of the property, so they would probably be staying in the home. So let's start with foreclosures and abandonments. And again, we're pairing these together because we're going to treat them similarly for tax purposes. These both get treated like a sale. And we're going to discuss a little bit more about this in our next lesson for capital gains and losses. So this is just kind of a really brief introduction to the idea. Whenever there's a sale, there's an amount that is realized, and we might kind of loosely call that the sales price. And then there's also a cost. What did the taxpayer put into this piece of property to acquire it? Or sometimes they might have improved it, and that will add to the cost. There are some other things that can happen that lower the cost. Again, we'll talk more about in our next lesson. So there are some adjustments to this cost. And so we call this the adjusted basis because it acknowledges that sometimes there's some changes to that cost. But to calculate a gain or loss, we take the sales price, we subtract, the cost, and then we get our gain or loss. And the reason why we brought up that there are, 2 kinds of debt, the recourse and the non-recourse, is because there are differences in how we treat recourse debt and non-recourse debt. So with recourse debt, that amount realized, that sales price, is considered the fair market value of the property. Whereas with non-recourse debt, that amount realized is the balance of the debt at the time of the distribution. And the way that these differences function when we start looking at how we're going to treat the canceled portion of the debt is that with a recourse debt, the canceled portion of the debt could also produce ordinary income. So you might expect a gain or a loss calculation, and then you're also going to see some ordinary income or have some ordinary income that would need to be excluded. That's where this exclusion that we're going to be talking about comes from. So it's with the recourse debt that we may be able to qualify for an exclusion. With the non-recourse debt, because the balance of the debt at the time of the distribution is considered part of the amount realized, that canceled portion of the debt is effectively included in the gain or loss. So what does it look like when our clients come in with this sort of situation? Well, if we look at the 136.14c, in that Part 5 for life events, it's on page 2 of our intake form, right there in question 2. And we saw this before again with the credit card debt that might have been canceled or forgiven. But here again, we're looking at a home foreclosure. And the forms that we're going to see, the informational forms associated with that are going to be a 1099-C and or a 1099-A. And here is the form 1099-A. So this is something that a lender will produce and send to a client who has had a foreclosure or an abandonment of the property. And so there's a date associated with that, there's a balance outstanding and a fair market value. And I just want to point out, we have box 5 there, where it will be checked if the borrower was personally liable for the repayment of the debt. So if that's checked, then we know this is a recourse type of loan. 1099A really gives us the information about the gain or loss. It doesn't really tell us much about the cancellation of any debt. And we'll talk about in a couple slides here what that means for how we will be reporting things. And this is the 1099-C, and this talks about the cancellation of debt. And here again in box 5, we have a place where it can be checked if the debtor was personally liable. Is this a recourse type of loan? And you'll see in 1, again, there's a date. 2 is the amount of debt discharged. And then there's some other boxes. Box 3 puts us out of scope if a taxpayer comes in with an amount in box 3. But it's important to note that our clients could be coming in, if they have this situation, with just the 1099-A. They could be coming in with a 1099-A and a 1099-C, or if the foreclosure and the cancellation of debt happened all together in the same year, then it's possible that the lender will only provide a 1099-C. And you can see in boxes 6 and 7, there is space for the lender to report some of the same information that the 1099-A was reporting. So the first thing that as volunteers we are going to do when somebody comes in with that box marked on their intake form, or they're coming in with informational forms, 1099-A and or 1099-C for a foreclosure, we're going to be looking up this publication 4731A. And this is also included right in the 4012. It's on page X. 2 and 3, and X just means legislative extenders is kind of the code for that. And this is a screening sheet for foreclosures and abandonments and cancellation of debt. Specifically for the VITA program, it helps us determine whether or not this situation is going to be in scope or out of scope. We can handle some of this, but these tax situations can get very complicated very quickly, and so we really want to make sure ahead of time that we are only preparing returns that are in scope for our program. And part 1 is for when a taxpayer comes in with only a 1099-A. And then we can go through the questions to determine whether we are able to do this type of foreclosure, and it gives us a little information about how to treat it, how we're going to be treating it. And part 2 is for our taxpayers who come in with both a 1099-A and a 1099-C, or possibly just the 1099-C. And here again, we go through a series of questions determining, is this in scope for us? And then it tells us, once we determine that it is in scope, how are we going to treat this particular situation? And here are some of our scope issues, and there are quite a few. So we need to determine that the home was never used in a business or as a rental property. These are situations that can cause depreciation to need to be calculated, and if you remember from our business income lessons, VITA, we don't deal with depreciation. We're going to say that's out of scope for the whole program. Also, the debt was not canceled because we need to determine that the debt was not canceled because the taxpayer filed bankruptcy. This is similar to how we were treating our canceled credit card debt. If somebody had this debt canceled because of bankruptcy, then they need to see a professional preparer. And extending on that, the taxpayer should not be in bankruptcy when they come to the site for assistance. They need the help of a paid preparer at that point. As we talked about before, 1099-C cannot include an amount for interest. That's going to create a more complicated tax situation. And we talked a little bit too about this towards the beginning, that the debt must be a mortgage used only to buy, build, or substantially improve the taxpayer's primary residence. So again, the money cannot have been, when they got this loan or they refinanced a loan, a lot of times it's a cash out refinance. They cannot have used the money to pay off credit cards, medical or dental expenses, vacations, etc. And then the mortgage needs to be secured by the primary residence. And the mortgage, there's a limitation on the exclusion. So the mortgage cannot have been more than $750,000. And of course, for our married filing separate returns, that amount is cut in half to $375,000. As we talked about before, our foreclosures and abandonments are treated like a sale. And when we have a sale of property, we need to report that on Form 8949 and Schedule D, and that's where we're reporting the things like the sales proceeds and the adjusted basis to figure out that gain or loss. And it's really important to make note that if there's a failure to report a foreclosure or an abandonment transaction on the 8949 and Schedule D, the IRS is maybe going to be coming back to our taxpayer to ask questions. So we really want to make sure that we are treating this appropriately and that we are getting that reported on Form 8949 and Schedule D. Now, I'm not going to go into how that works specifically in this lesson. Again, we're going to cover it in our capital gains and losses lesson, but this is just an awareness issue. And then specifically with our main homes, our principal residences, it's important to note that losses will not be deductible, and that gains may be excludable as a sale of a main home. And again, we'll discuss more about what sale of a main home entails in our next lesson. Next, we need to look at Form 982. And as we talked about at the beginning, if we have recourse debt or debt that the taxpayer is liable for, if that debt is forgiven, it could result in ordinary income. And in order to exclude that from income, they would need to fill out Form 982. And there's a little checkbox on line 1E that says that this debt was the discharge of a qualified principal residence. And then line 2 allows is where you report the amount that is excluded. So that kind of covers how we deal with foreclosures and abandonments. Remember, we're going to have a gain or a loss to report, and we're possibly going to need to exclude from ordinary income a cancellation of debt. So with a mortgage modification or a mortgage workout, in this case, the owner is staying in the home. The home remains their property. So it's not treated like a sale. However, the cancellation of debt does affect the owner's basis, remember their cost. And we talked about, sometimes there are things that happen after the initial cost that can raise the basis, the input that the taxpayer paid into the cost, or there are things that can lower the basis, things that the owner received a benefit for, and so that's going to lower the amount that they have as cost in this property. So in this case, the discharge of debt lowers that basis, right? It's like as if they were getting paid back or refunded some of that cost. So they had the original cost and then they lowered it by the amount of the discharged debt and they get an adjusted basis. So it's a new lower cost. So again, we have some differences in how recourse debt and non-recourse debt gets treated. So again, with recourse debt, that canceled portion of the debt would result in ordinary income unless our taxpayer qualifies for an exclusion. With the non-recourse debt, generally speaking, the canceled portion of the debt does not result in ordinary income. However, we have a couple of caveats. So if the owner is offered a discount on early payment, so they pay off a little bit early and they don't have to pay as much, then that is going to be considered something that will produce an ordinary income for that reduction in what they owe. And then also a modification that resulted in the reduction of the principal balance, right? The loan principal amount. That's also going to possibly result in ordinary income. Again, with those two caveats, that's unless our taxpayer qualifies for the exclusion. And then this is really important. If the canceled debt is reportable as ordinary income, meaning the taxpayer only qualified for a partial exclusion or they didn't qualify for the exclusion at all, their return is out of scope for us. So we need to make sure those other scope issues that we talked about need to be fulfilled in order for this cancellation to qualify for the exclusion. So again, if there's going to be any income that is reported, we need to send that person to a paid preparer.